All right, today we are diving into what is, for all intents and purposes, a bare-knuckle brawl on Wall Street. And listen, this isn't just about some stock prices going up or down. No, this is an alleged all-out institutional war. The claim that America's biggest bank, JPMorgan, has been trying to absolutely crush Michael Saylor's company, MicroStrategy, because of its massive bet on Bitcoin. So yeah, let's get into it. And right in the center of this whole firestorm, you've got Michael Saylor himself. I mean, as his company is facing this incredible, coordinated financial onslaught, his message was just simple, direct, defiant. This one quote, really, it sets the stage perfectly for a conflict that pushed the absolute limits of corporate strategy and, frankly, financial power. Okay, let's be crystal clear here. People who have looked into this don't just call it market volatility. They're alleging this was a rigged game, a coordinated attack on Bitcoin and MicroStrategy shareholders. The whole point? To engineer a total collapse and then profit from the wreckage. This is basically the story of a siege. So meet our two main players in this drama. On one side, you've got the incumbent, the big dog, JPMorgan Chase, a literal titan of traditional finance. And on the other side, the insurgent, MicroStrategy. You know, the software company that completely transformed itself into the world's largest corporate holder of Bitcoin. It's a classic David versus Goliath story, except in this version, Goliath has some very sophisticated slingshots. So how exactly did this alleged attack even begin? Well, it started with a tactic that sources have nicknamed the Roach Motel Trap. And the idea is brutally simple. It's really easy for investors to get in, but it's pretty much impossible to get out without getting completely crushed. And this number right here? This was the weapon. According to the reports, JPMorgan jacked up the margin requirement on MicroStrategy stock to a staggering, almost unheard of 95%. So what does that even mean? It means for every single dollar of MicroStrategy stock you wanted to buy using borrowed money on margin, you had to put up 95 cents of your own cash. Just like that, leverage was instantly killed, gone. This breaks down exactly how the trap was supposedly sprung. Okay, so first, that 95% margin requirement, it triggers immediate margin calls all over the place. Then, step 2, JPMorgan allegedly blocks its clients from transferring their stock out. There's literally no escape route. And the final step? Well, it's checkmate. With nowhere left to run, clients were cornered and forced to liquidate their shares, right there, on JPMorgan's own platform. Now, you gotta understand, this wasn't just a single move. This was a full-on, multi-pronged assault. While they're squeezing their own clients with these margin calls, JPMorgan also puts out this super bearish research note warning everybody about a massive structural threat to the company. And get this, at the exact same time, their own filings show they were dumping a huge chunk of their MicroStrategy holdings. So they allegedly created the panic, and then they sold right into it. And that bearish research note I just mentioned, you know, it wasn't about the usual stuff like earnings or revenue. Nope. It was about something way, way more dangerous. The threat of MicroStrategy getting kicked out of the entire stock market ecosystem. And this is the little technicality right at the heart of the whole threat. See, the big index provider, MSCI, proposed a new rule. It was aimed at what they called digital asset treasury companies. And the definition was pretty simple. If a company's crypto holdings go over 50% of its total assets, boom, it's not considered an operating company anymore. It gets reclassified as a fund. And the problem? Funds aren't allowed in the major stock indices. And this number, wow, this really illustrates the potential damage we're talking about here. If MicroStrategy gets delisted from the MSCI index and then all the other major indices follow suit, it would trigger a mandatory, totally automatic sell-off by all those passive funds. The estimated forced outflow, a staggering $11.6 billion. And that's not a prediction, right? That's a mechanical certainty if that rule passes. But just as the siege was hitting its absolute peak, a counterattack started to form. And it wasn't some big corporate action. No, it was a signal, a quiet signal, from a really unexpected corner of the market, from what a lot of people call the smart money. First things first, Michael Saylor himself went on the offensive. He just forcefully rejected this whole passive fund label. His argument was pretty straightforward. Look, MicroStrategy is a publicly traded operating company. We have a $500 million software business. He claimed they don't just passively hold Bitcoin, they actively create, structure, issue, and operate in the capital markets. A totally different thing. And this is where it gets really interesting. Because while giants like BlackRock and Vanguard were selling off billions of dollars worth of stock, a totally different kind of player quietly stepped onto the battlefield. And their move? Well, it was about to change the game. Okay, this comparison right here is absolutely key. On the left, you see JPMorgan's tactical sale, about $134 million. On the right, a much smaller $16 million purchase. But it's who the buyer was that matters. The New Jersey pension fund. I mean, pension funds are the definition of conservative, long-term capital. The fact that they decided to buy in the middle of this firestorm, that was a massive vote of confidence. Sources argue that this $16 million smart buy carried way more strategic weight than that much larger tactical sale. But even with this powerful countersignal, the attack had already done some serious damage. It struck right at the very heart of MicroStrategy's whole financial engine. And that engine, it was called the Accumulation Flywheel. It worked like this. For years, MicroStrategy stock traded at a huge premium to the actual value of the Bitcoin it held on its books. And the strategy was brilliant, really. They would issue their expensive stock to the market and then use that cash to buy more of what was, by comparison, cheaper Bitcoin. This whole virtuous cycle, this flywheel, was their single biggest advantage. But this attack completely shattered that premium. The company's market value compared to its assets, the NMV ratio, which at one point was trading at over 2.5 times the value of its Bitcoin, just collapsed. It went all the way down to nearly 1-to-1. And with that premium gone, the flywheel just seized up. MicroStrategy's ability to raise cheap capital and keep buying Bitcoin was effectively crippled. So once the smoke of the battle started to clear, a new defensive line was drawn. During the absolute peak of those forced liquidations, what some called the shakeout, the stock hit a hard bottom at $166. And this wasn't just some random number. It was the point of maximum pain, and it was reinforced by that pension fund's smart money buy, establishing a brand new floor that the bulls could now defend. So in the end, MicroStrategy survived the siege. There's no doubt about that. But its core strategy was badly crippled. And this whole affair, it really leaves us with a pretty critical question about how modern markets work. When finance becomes actual warfare, who's really in control? And maybe more importantly, who gets to write the rules of the game?